Hello and welcome to the Investing Master Series. My name is James Boyd. We welcome you here today. Alongside with me, my good friend Connie Hill in the chat. This is where the redheads take control here. Little inside joke, okay? So, and we look to welcome all of you, WW, Silas, JP, PR 451, Debbie, good morning to you. And we also have Dragon Rider, Ellie, Elena, Amanda, Grace, and many others. Welcome to all. Now, today's topic, I really want to kind of talk about managing of a portfolio. You know, you might be asking yourself the question, can I really do this? I think the more I've thought about it, it really comes down to not understanding a strategy. It actually really comes down to how confident do you feel in managing a position, a strategy, a portfolio. The stronger you are with and where you feel like you are in terms of managing a position, a strategy, or portfolio, the more likely you're probably going to see potential opportunity in the market for you. That does not mean that you're going to trade every strategy, but you actually might find something for you that you might like and feel comfortable with. That's the goal. So today I really want to kind of talk about some management of stock and option positions and also some new positions as well. Now remember, you can follow Connie or myself on X. We do post educational content there as well and announcements. There was a question regarding scripts. Remember that Connie, she posts her scripts on X. If you go to that handle, at James Boyd CS or at Connie Hill CS, you're actually going to notice that we post our scripts just right at the top. So quick heads up there. Now, as we get started, remember our examples are going to be stocks and options based. Also understand that when we talk about options, options carry a high level of risk and are not suitable for all investors. So different options really kind of have some different profiles to them. So you want to be kind of aware of what is the strategy trying to do? What does it have exposure to? Is it something you would consider? Also remember that the information here is provided for general informational purposes only. Also, when we talk about examples, those will be done on the Paper Money software application. And also remember that investing involves risk, including loss of principal. And also when we talk about examples, they are just that. Short options, again, we're talking about American style options where they can be exercised prior to expiration, not just at expiration. So we just have to understand that. And we will have an example of that here today on covered calls and short puts. Now, what I want to do is I want to kind of talk about just real quick something, and I want to kind of write this up. So I want to give you a full understanding, okay? So when we're talking about kind of setting up a portfolio, we talk about stock positions. Sure, okay. We talk about, for example, let's say CSP. I'm going to label that as cash secured puts. We also, for example, talk about covered calls. Okay, I'll just put CC. And we also talk about LS, which we label that as long synthetic. The stock in the long synthetic, they're similar. Okay, long synthetic has the expiration, but it's trying to get the same, trying to replicate the profit loss diagram of a stock position, but through options. When you kind of think about a cash secured put, it's the potential ownership of stock, okay? And if you look at a covered call, it is a stock position, but it just has a covered call. These cash secured puts and covered calls are really about direction, okay? So you're trying to get the upside direction, but you're also trying to get the time decay. So really there's four strategies right there, and they all relate back to the stock. If we take a look at, let's say, the SPV, the short put vertical, we know it's probability-based strategies. Long call vertical, we call it a profitability-based strategy. You're trying to play more of the direction. You don't have that time decay with you. And the last one, or second to last, we've talked a lot about callers since we've actually had earnings, okay? And if you think about, well, what is callers? It's a stock position and a cover call. And if you take a look at this, married put, okay? Does a stock position with a caller, do we need the stock position? Yes. With a married put, buying the stock and buying the put, do you need the stock? Yes. So much of what we talk about is really coming back to the stock, okay? So if you kind of think about it in this class, we really talk about 8 main bullish strategies. I have included the married puts here. Why? Well, because this morning we actually had the VIX and it went to 14. The married put actually becomes a little bit more interesting the lower that the VIX goes, okay? Now, over your lifetime, You might say, which strategies interest you? These are the strategies that interest the paid money account. That does not mean other strategies are bad, but these are the ones that we're going to focus on in the Investing Master Series. Now, you might say, James, I like to do cash secure puts. Fine. I like to do covered calls. Great. You might pick 2 or 3 that you might start with. Now, let's kind of go into this and kind of talk about where the markets are, and let's kind of talk about these strategies. We're going to talk about new positions, but we're also going to talk about past positions with these strategies in mind. Now, what I want to do first is when we pull this up, I like to kind of go back to, I like to kind of be systematic in what we look at. So remember, we kind of said that if we were just waking up, okay, we might look at that list. And I label them number 1 because I want to know step 1, step 2, etc. For this class, we're going to just go to indexes. And if we look at the indexes, first off, what we want to kind of get out of this is these, now, by the way, someone asked me, can you share this list? I can't share the list. You could take the symbols and make your own list. Sure. Okay. First off, something that kind of is different here today. So first off, the dollar index, did anybody see the dollar this morning? Dollar has actually had a pretty good reversal after the EU-US trade deal. Okay. That dollar is actually starting to push back up, which it had not been for a long time. And we're actually seeing the other currencies pushing down below the support. That's the euro, the pound, the Swiss franc, the yen, the Canadian dollar. That US dollar that we thought, hey, could be at risk, which it has been, that's starting to actually push back up. Now, nothing completely unusual. We actually see the NASDAQ actually still up, a gap to the upside. SOX gap to the upside. The S&P is pretty much flat, down 4 whopping points here today, and the Dow Jones sitting here at down 150 points, or in other words, 0.3%. So kind of the big takeaway so far is we're still seeing NASDAQ and semis, which has been the theme for a while for the most part, okay, outside maybe about two weeks ago. Gold is actually still kind of holding up there as well. So let's kind of take a look at, just real quick, these charts. If I looked at the SPX, we did hit a brand new high on the SPX. Now remember, this kind of goes back to the point of this class. It doesn't matter if the index hits a brand new high. If someone doesn't feel like they can't find positions and manage positions, it doesn't matter how high the market goes. Okay? So my goal here today is to help us be more confident in managing the position and kind of maybe building that belief, hey, maybe I could do this for myself in the way that you want to trade and invest in the market. When we look at the moving averages, those trusted moving averages, right? We've had green lines on the moving averages for a while now. Again, the 10-period moving averages tells us about momentum. The 20-period moving average tells us about trend. And it's been telling us as investors, okay, there's been an upward trend. The shading just reminds us of that real quickly. We're in a more of a bullish trend right now. Now, if we go back to, let's say, the NDX, and I'll share those charts with you in just a moment, the NASDAQ did gap to the upside. We've kind of been doing what I call the slow drift, okay? And I call it that the market kind of grinds higher. Not super quick, but it's just like, hey, the higher lows, which tend to be these short, shallow pullbacks, they're just still going up. And if you look at, let's say, the Dow Jones itself, pull that up, you're going to see that it's sitting right there. It's trying to really break above the 449-ish area. Has not been able to, the keyword is yet. Still bullish, but kind of facing a little short-term pullback so far. Now, sectors, okay? Now, let me bring up just VIX real quick because this is worth looking at. When you look at the VIX, today we did flush down to 14. Now, remember, if you don't connect these 2 points, this is very important. If the VIX is actually flat or going down, typically there tends to be more bullish examples than bearish examples. If I ask you a question on this chart, do you see a bullish divergence on this chart? What would you say? What would you say? Do you see a bullish divergence on the chart? Any takers on that? Well, yeah. Now, Lisa, calm down. Now, by the way, Lisa's a redhead too, okay? And if we take a look at this, I don't see a divergence, okay? The only real divergence she had was really back here. and it popped a little bit. It popped to 19. That's what the concern is, right? We see that. We don't see a divergence, the keyword is yet, okay? So the concern, and we've talked about this a lot, right? The concern is when the VIX is low and the MACD is diverging. Price making lower lows, but the oscillator going the opposite direction. The risk is that the prices could fall down and break down below the support level, okay? Now, when we talk about, let's say, sectors, just real quick, of course, we would say technology, they hit a brand new high. The one we want to kind of also keep an eye on here is energy, okay? Energy in the last 2 days, we've seen crude oil and gasoline get a little push. Could we be starting to see the emergence of energy, okay? That has not broken through the 935, 940 level keyword as yet, but we're kind of in those summer months where we could get a potential hurricane, whatever, that might disrupt some potential inventory levels and so on. So keep an eye on that. Now, what I want to do, and this is very, very important in terms of the goal here, want to kind of talk about some positions. Now, let's kind of start off with, now, if you follow my classes and Connie's as well, you're going to see that we do example trades, okay? You could talk about theoretical strategies all you want, but at the end of the day, it comes down to show me some examples, okay? We're in a paper money account, and what you're now going to notice is I'm going to kind of talk about some different examples. So if I were to look at this, and we a lot of times when we manage a portfolio, it's probably not just going to be one strategy. Okay, you might have 2 or 3. I already went over the strategies we talk about. I want to talk about managing some of those strategies now. The first example that we're going to look at is a short put, a cash secured put. Simply meaning if you sell the put, you're actually saying, I don't mind to buy the shares at the strike price. If you sell the put, it's a bullish strategy, of course. And what you're now going to notice is if we look at Chevron, the paper money account sold the position on the, this is the 15th August expiration, has 17 days left. It was sold for 405 and now it's at 86 cents. Now, I want to kind of give you some understanding of this. Why does this row really show a trend 3? That's the stock. And this row right there is really showing a 1. Why does it do that? Well, so the first row, 1, that's the stock. And the second position is if we were to graph the option position itself, the 150 put, it's actually saying what type of trend is the option pricing in, or the option price in. Well, if you sold a put, you would not mind trend 1 because that means that the mark price is dropping down lower than what you sold it for. That's good. So that was a question that got brought up. So we don't really, I mean, that's what it is. That's why there's a difference. Now, if we take a look at this position, what you're going to notice is it's 78% of the maximum gain. In other words, if we took, let's say, $319 and we divided that by what was the premium received, 405. And that's where we're really getting the 78%. Now, we got to ask ourselves the question, should the investor just take the gains or roll the position? Now, for some reason, I want to kind of point out Amanda here, okay? So Amanda, let me ask you a question. If we looked at, let's say, Chevron, okay, and we said, do we think this is a position where the investor wants to roll the position? Now, roll just means you're going to profit take on the position now, and you're going to sell another one. Is that a good idea? Is that something maybe the investor wants to do? What potential risk is that? Amanda, let me know if you have any thoughts on that. Now, if the investor said, well, I'd like to profit take, and I'm able to profit take at a pretty high percentage, but I don't have to hold over earnings. Second thought is, I want to roll the position, close out what we have now, and I want to sell the put and do it over earnings. Risk to that is, well, we don't know what the earnings is going to be, how investors react, and the price might come back right back down. So that second option is kind of a little risky, but that risk is actually it's actually inflating the option premiums to a degree. So now Amanda says earnings. So let me ask everyone here. Door number 1 was just take the profit. Do not roll the short put. There's gap down risk. There's always gap down risk, but especially on earnings. Second door is James, roll the position. Profit take, enter the new position, go over earnings. Would you pick door number 1 or door number 2? Or I should say it like this. Open the case. I'm always interested. Okay, so here it is. So here's the deal. If someone says, well, roll it if you can do so for a credit, does that mean that you just say, forget the earnings? Okay, so that's the question here. If you resell the put, you're pretty much planning on holding over earnings. Do you want to hold over earnings? Many of you are actually saying, James, open the case number 1. Open the case number 1 was actually just saying, look, take the money and run. So here's where we miss the opportunity to buy the shares. Now remember, if we go back and say, where was that position placed? It was on 7-8. 7-8, let's go back and see what this looks like. Where was that on the chart? And I want to circle this. Where was 7-8? 7-8 was right here. Now, when we go back to the position, why did the paper money account get in? It was above the 10-period moving average. It was above the 20-period moving average. And it was at a short-term high. That is consistent with a lot of things that we talk about. That was also a close above the high of the low day. It was a 20, 55-day high. Nothing unusual. Kind of more of the run-of-the-mill setup. And it was just a cash secured put. So trade example number 1, we're going to right-click, not roll this position. We're not going to resell the position and hold it over earnings. We're going to say, look, we want to get through the earnings here and re-look at this to see if it's still above support. We're going to buy the option back at 86 cents. So in about the 3 weeks worth of time, $319, less the commission. Notice that, less the commission. That's the net. So what we're doing is we're making the difference between what it was sold for, what we're buying it back for, less the commission. Okay? The commission was 65 cents on the front, 65 cents on the back. So if you get real technical and say, okay, we're at $3.19 less $1.30, that's going to give us a sense of what really, if we can get filled, what's really there. Now, if we buy that back, we want to not assume that it gets filled. We want to verify that it gets filled. Just because I put my order in doesn't mean it takes it. I need to get a match, okay? And we're going to just make sure that fills. Now, I want to go back to the second trade. A number of you have talked about covered calls, okay? Now, how many of you like to do covered calls? You like to buy shares? Now, by the way, this could be shares of stock. Some of you like to actually do it maybe with ETFs as well. This is where the investor says, look, I want to have a directional bias to what I think the stock or the ETF is going to do. I bring up ETFs because Connie teaches those Monday afternoon. Do not miss that, okay? She does a great job. And also, for example, Kevin and I teach those on Friday. So make sure that you're joining. And there's a reason why we talk about that, because some people like around earnings to kind of maybe have exposure to those if they would consider that for themselves. This really what the covered call is. You own shares of stock. And where was the stock purchase? It was purchased on June 18th. Let's go back and look at this chart for just a moment. And we want to kind of see what type of trend we've actually been having. June 18th. June 18th was right there. So if we went back, and what I'm trying to really get a kind of a judgment of is, was this a bullish trade at that time? Did the paper money account buy it in an uptrend? I think we'd have to say yes. Did the paper money account buy it when it was above the 10 and the 20? Yes, that's a foundational concept, right? Why would the paper money account buy it there if the prior high was there? Clearly because the paper money account thought it was going to go higher. Now, if we take a look at this, you're now going to see that it's run to the upside and pull back a little bit. Now, I need you to also notice that if we click on that there, you're going to notice that the covered call was done on 7-1. Now, is this a buy right? That's language of buy the stock and right to call at the same time? Or was this a leg in, meaning buy the shares first, and then later, when the stock starts to maybe consolidate or pull back, then sell the call? This is a leg in strategy. Let's go back and actually see on July 1, where was that? Where did the paper money account actually sell the call? The paper money account, well, better than I thought. Paper money account sold the call right there. Why did the paper money account sell the call right there? The purpose of the whole moving averages is to kind of show us maybe the trend change in trend. We had a green moving average. When that moving average is green, 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 the investor's trying to be bullish the trend. Okay? When that moving average went red, we didn't know if it was going to pull back, but we said, hey, we're going to sell the call. If you have shares and you sell a call, you're still bullish. Okay? Now, I want to go back to, now, by the way, that actually worked out pretty decent. Now, sometimes you surprise yourself, right? We all do, right? And actually, the timing was actually quite interesting. Now, if we go back and kind of take a look at this, it's really gone sideways to down since. Again, sometimes you just say, wow, that was solid, okay? A little fun there. Now, we got to ask ourselves the question, well, how much could we make on this position? Let's just say we bought those shares at $65.97, and we have the obligation to sell the shares at $67.50. Now, remember, it's not just the obligation at expiration. It's the obligation now. We've said to anyone in the world, it could be in blasted Ethiopia or southern France. We've said to anyone in the world, I will sell you the shares at $67.50 from now until expiration. Now, when we take a look at this position, we got from $65.97 to $67.50. Tell me what to do with the position. And by the way, if you're not good at managing or exiting, there's a really good likelihood that you struggle with entries, okay? And if we take a look at this upside, it's going to be $1.51. Just basic math there, not too bad. Now, that's a stock appreciation, okay? Now, how much do we get to sell the call? It was $3.10. And if we take a look at that, that's going to give us a maximum gain of $4.63. That's the max gain. Got to ask yourselves the question, where are we now? Well, we are at $316 of the 416. Now, some people want to be in the position to just say, I want to own the stock. There's other investors that say, look, I don't care about the stock. I care about the maximum gain. When we take a look at this and we say, kind of let's run the numbers, $315 divided by 463, we are at right now 68% of the maximum gain. So if we held all the way to expiration, we'd have to, that would be, and we closed above the strike, it'd be $463 max gain. If we just profit take now at 68% and say, let's try to do it again, well, some investors, that's what they're trying to do, okay? So how do you close the position down? So door number one is we're at 68%, and I'm going to try to go for more. Not the greatest strategy because, well, how much more do you actually really have to make? Less than what you could lose. Door number two, James, take actually the 68% and look to actually play again. Now, what I'm going to do is I'm going to take door number two. We're not going to be in love with the stock. We're going to be in love with actually the maximum gain or the percent of maximum gain. We're going to right click on that, create closing order, and we're going to sell the covered call. Now, why did you get in the stock market? Did you say, I really want to own a certain stock? Or did you get in the stock market or invest in the stock market for the money? I've never met anyone that said, man, I really just fall in love with 3 letters or 2 letters or 4-letter symbols. That's really what I want. No, it's usually the money, okay? The potential. And when that's there, some investors say, look, I'm going to grab that. Now, I'm going to say this. Some of us are so nice. We let so many other people profit take first before you try to get your paper trade off the table. This is where being selfish and thinking for yourself could be helpful, okay? And it's for you. Now, in this paper money trade, what you're going to notice is we're selling the shares, but it's buying the callback first, okay? And trade number 2, we're going to sell that, and we're going to try to take 68% of the maximum gain here. Now, want to go back and say a quick point. If you struggle with managing of current positions, you're probably struggling with entries, okay? If you're struggling with current positions, you're struggling with entries, It doesn't matter how high the market goes because you're not comfortable. And if you're not comfortable, then you're probably missing out on some of the potential in the markets. So in the trade example number 1 we did, it was a cash secured put, which is not filled. I'm going to come back into this, and sometimes we just need to move the price by just a little bit. I'm going to move it up about 2 cents to see if we can get it filled. And it went from 86 cents to 88 cents. And the cover call has yet to be filled. So we want to watch that, and we will. Now, the last example that I'm going to look at, well, let me talk about a new position first, and then we're going to come back to an existing position of a stock and a caller, which is a stock. Now, let's kind of talk about some new positions here. One of the stocks that we've been kind of like looking at the last couple of days is a small company called Goldman Sachs. Now, I want to kind of just take a look at this for just a moment. The charts that we use in class, we got to put them in a package, if you will. That's why I call it the package. Let me send this to you because I'd feel horrible if you didn't have this, okay? And there's reasons why we use this, okay? Now, the charts that I sent to you, how do you put them on yours? Well, if I go up to the very top right, click on setup right there, setup, open shared item. And what you're now going to do is I'm just going to copy and paste in what I sent to you in the chat, okay? Now, it doesn't matter if you've done this before. I added one this morning, okay? So it doesn't matter if you say, I already have it. You don't have what I updated it to, so grab it. So if I click on now preview, it says, let's import the charts that I'm sharing with you. Let's import it, bang. Now, if I do that, where does it go? Comes up with a couple little charts, okay? Now, before I even open these at all, you see the little box there with a couple, like you got a couple squares in a red box? Click on that. And I'm just gonna say save grid as, and I just call it the package of charts, in other words. And that's how you could actually just save it to your side. If you said, show me that one more time, go to the top right, setup, open shared item, not too bad, and then just copy and paste. What now? You just click on preview. This is recorded, preview, and then import. As soon as you do import, there's the small charts again. How do you save? You click on the box right there, go down to save grid as, and then you name it what you want. Now, this chart is actually, these charts are important because charts you kind of like to use at different times. There's different reasons. It's like different tools. Now, if I pull this up, the first chart is going to be the whole moving average, the 10 and the 20. The second chart is going to be looking at the breakouts. Now, I don't know if you know this, but sometimes we like to show examples of breakout trades. These lines on the chart are really showing different durations of times of breakouts. The orange, the blue, the white. And all we're doing is, so those lines are just showing breakout setups. If the price hits those, okay, you're getting a shorter term breakout, intermediate, longer term, and so on. Obviously, the orange is going to be a shorter duration of time. Some of you like to trade short term. That's the point there. This third chart is really showing, in this case, the breakout scripts or lines, but it's also showing the stop adjustment lines over time. And we're going to come back to that. That fourth chart is really showing where those stops could be currently and over time. The fifth chart is really showing what we call the trend candlesticks, okay? And that is using a 10-day exponential and a 30-day simple, which many people probably started there. Nothing wrong with that. There's reasons to look at that. That is using a daily chart, okay? And the candlesticks are mimicking the trends that we talk about, like trend 2, 3, etc. And you're going to see that if we went to the next chart, the chart that I added, which I think is important, especially on the weekends to look, is the weekly charts. Okay? And I want to do less work. Okay? So I just want to kind of look at these charts and flick back and forth and not change too many things. That's why I added that last chart. Now, if I take a look at, let's say, Goldman Sachs for just a moment, let's use this chart for just a second, okay? The foundational concept for any trade that we look at in terms of bullish is that the stock is above a 10-day moving average. And or with that, the stock is above the 10-day moving average and 30-day moving average, etc. But the guiding principle, practice, is the stock above the 10? If the stock is above the 10, there could be momentum and a potential trend. Now, if we went to this chart and I asked you a question like, hey, what type of trend do you see? Well, we might say, well, James, the trend that I see on this chart is I kind of see maybe like a horizontal resistance, and maybe I see in this case some higher lows. Now, let's kind of turn ourselves a little bit to trading here. Now, in this daily chart, we saw orange color candlesticks on a majority basis. Okay, orange, and 1 day purple. Okay, 1 day. So first off, we've kind of talked about this. If we only get orange color candlesticks, what does it tell us about momentum? What does it tell us about the likelihood of the stock price going higher? Probability-wise, what does it tell us? Well, if we only get orange color candlesticks, okay, that's a shallow pullback. And if we get an orange color candlestick and then it gives purple, but then it pops right back, that's just screaming out loud, momentum, momentum, momentum. Be on the lookout for the stock really breaking resistance. Now let's go back to our strategies. At some point, you could look at charts ad nauseum, but at the end of the day, you got to ask yourself, well, what strategy are you going to use? These are your tools. Now, if you said, well, am I going to buy the stock? The stock price might impact what type of strategy that you pick. Consistent with what we talked about historically is, if we have a stock that's probably, let's say, up $100 like this one is, some investors might say, James, without even thinking about it, I'm kind of thinking about more about verticals. That's why a lot of people like verticals, especially in these higher price dollar stocks. We said the short put verticals are really done for more probability basis. They're not as high profitability, okay, because you have probability if you set it up the way we talk about in our examples. And the long call vertical is more about profitability, but less probability. Higher profitability, less probability. Okay, just making sure I heard that. Now, I'm going to focus on a short put vertical. Let's say the investor says, I want to trade bullish, but I want to kind of think that the stock could stay above a certain price. Wonder if I'm not as positive. Okay, now what I'm going to do is going to come back into the paper money account, going to type in GS. Now, if you don't mind right now, we're going to kind of push some trades here, and we're going to kind of do them a little faster. I mean, why not? Now, remember, on most of our examples, the 15th of August are probably not as relevant because they only have 17 days expiration. We're going to go down to the 19th of September. And the example that we're going to look at is we're going to look at, let's say, the delta between 30 to 40. If we look at the delta between 30 to 40, which is stating the probability of the stock being below the strike price by a penny, it's also stating if the stock moves $1, how much do the options move up or down by? Now, if we take a look at this, think of it as a translation to the option price. If we take a look at this and say, look, I'm going to sell this, say, example given, the 700, okay? And I'm just going to take a look at these just real quick. I want to see which one has a tighter bid-ask spread. Well, if we look at, we're not going to go this one. We're not going to go that one. That's 50 cents. That's 40 cents. That one's 40 cents. So the highest in our example that we would look at is the 705. Okay, and I'm going to choose the 705, selling that, and then buying the 700. We're going to sell the 705 and then buy the 700. Now, when we do this, and we talked about this yesterday, okay, in the IRA account, we have to kind of think back to, okay, how did we start the year? Where dollar-wise, what was the percentage we were willing to risk? We're willing to risk, let's say, a half of 1%. Half of 1%, 1% would be 1,100. Half of 1% would be about $600-ish. Well, if we come back into this and say, well, how many contracts are we going to do? Well, if we said, let's say the max loss, okay, selling the, and actually that's, let me take that back, delete. We're going to right click on that, sell, okay, sell vertical. Okay, now that We know that's the one we want because that's the credit, right? Now, if we take a look at this, we go to now confirm and send. Now we see it, okay? And remember, on the probability-based trade, the max profit should be less than the max loss. If we said, well, how many contracts could we do? At the most, the answer is 2 of them, okay? Now, what you're now going to see is if we take a look at the credit, this is for 1 contract. If we came in and said we're going to do 2 contracts, that's the most we could do, okay? And now we see the maximum profit and the maximum loss. Now what we're going to see in this case is the commission adjusted for the 2 contracts. And trade number 1 here, what we're going to do is we're going to send that order right there. Now, obviously, if someone is actually long Goldman Sachs, long just means they're bullish, and someone does a short put vertical here and they have positive delta, which you do, you think the stock or the sector, the market is going to continue to go up in value. We're going to send that order. And now what we see is trade number 1. Yeah, we fixed that. Trade number 1 did fill. Now, I want to go back to something just briefly. I did not see that on Chevron. Man, that's been stingy here today. Man, just tough to get a fill on that. Chevron, now it's at 92 cents. I'm going to try to get those filled in class because all of the trade examples are done in class. We started out at 86 cents. Now we're at 92. And the higher that we buy the putback, the less money that's made in the paper money account. Still not getting filled. I'm going to overshoot it a little bit, try to even go, let's say 93, which is higher, of course. And we're just going to try to make sure. Okay, so we paid 7 cents or $7 more than where we were at the beginning. Cisco has not filled yet. I'm going to go back in and make sure that one fills. And what I'm going to do there is push it to the mid price, confirm and send the order. Now, if we do that, what you're now going to notice is I want to make sure that gets filled. Do not assume that it does. Now, you're not teaching the class right now, so you could probably look at these orders more frequently than we are. But we want to make sure that we're trying to grab the highest percentage of the maximum gain that's possible, okay? Now, the other thing I want to do is I want to also go back to is I want to bring up the example of, let's say, I want to talk about this. Now, we've talked about callers quite a bit, okay? There's 2 examples that I just want to briefly touch on. And remember, the better that we are with management, the more likely we are going to be to enter probably because we have more confidence. And if we could be good at exits, managements, could be exits or rolling positions, etc., the more likely that we are to, if the market goes bullish, you might try to take advantage of that, okay? Now, we did a caller position. Now, how many of you have practiced those in your paper money account, okay? Now, notice that we bought the stock at 99, and we actually have, let's say, the upside potential to 110. Do the basic math on that. We have 1082 is the upside on the stock position, 1082. The call, okay, so if we take a look at this and say, well, how much are we up? Really, in this case, where are we at on that caller there? You're now going to see now that position on Cisco finally filled. So when we look at this position, we have from 99, okay, up to the 110. In other words, $10.82. Did we get a credit or a debit on this? The answer, we actually got a credit, okay? And if you don't mind, let's just say it was 95 cents. So if we said, what's the maximum gain that we can make on this? And forgive my math on this, I'm going to be close, 7. The most we could really make is 11.77. How much are we up on this trade? In an example, we're up 297 of the 11.77. We're up like 25-ish%. On this trade right now, we don't have a whole lot to do on this trade right now. We just don't have the percentages. Now, I want to kind of bring up a dynamic to you for just a second. Because remember how we kind of talked, if we're talking about how much do we have relative to the maximum gain, we're not there yet. Some of you, though, are traders. Can we go to that chart for a moment? Can we look at that and kind of say, James, I want to get out if we're seeing any sell signals? Well, Do you see any sell signals? Well, if we go back to this, what I want you to kind of look at in the last couple of days, we've had a red moving average line. Okay, that's the 10-period moving average. I'll label that. Then we actually had the 20-period moving average red as well. We also had the moving average cross down. Is that an example of confirmed selling? It is, right? The 10 would be the earliest signal, potentially the cross next, and or the 20-period moving average going red. If someone's in a collar and they only maybe have a percentage of the maximum gain, which we like example given that we have, and there's earnings where the investor says, James, I actually don't really want to hold over earnings on this. I'd rather take the $300 and then just try to get through the earnings. Okay? And then reevaluate to see if it's something the investor might consider on the other side of earnings. So can you just manually eject based off what you're seeing on the charts? And the answer is no. I'm joking. The answer is yes. Okay? Because there are some investors that say, James, I'd rather take the $300 than be in a situation where the stock is pulling back, pulling back, pulling back, pulling back. So let's kind of show the example on Robinhood. How do you actually get out of this? Well, hold the shift key down. What we're going to do is click on the caller first, okay? The caller is the call and the put. We're going to right click on that, create closing order. We're going to buy it back. Now, what we're going to do in this case is we're going to buy it at the mid price, and we want to make sure that trade fills. Notice the shares are not going to be sold until that collar comes off, okay? Now, just for class purposes, what I'm going to do is change this to a market. And that way we could try to get it to fill as fast as possible. Once that collar comes off, then step 2 is we're going to sell the shares of stock. Do you understand what I said in terms of could you like manage or exit a collar based upon the technical analyses on the chart? Sure. That's the same way you could do it for a vertical, okay, or a cash secured put. The same idea. Yes, you did not make that maximum gain, but you're just trying to kind of ride that trend as long as the trend is still strong. All right, now let's look at this last one just real quick. Newmont, okay, bullish position, and I want you to tell me what the paper money account should do. This is your opportunity to be the boss man or boss lady. Well, if we take a look at this 58.64 and we sold the call at 62.50. Now, I think if I just pulled the calculator out, how much is that? The answer is going to be 58.64. That's going to be $3.86. Let's put that right there. That's the stock appreciation up to the short call. Okay. Now, did we get a credit or a debit? And the answer there looks like we got a credit of about 31 cents. Let's add those two together, 714, $4.17. That's the most we can make on the collar. So we're now asking ourselves the question, how much of the 417 do we have? So if we go back to this, what you're now going to notice is how much of the 417 do we have? The paid money account, if we take a look at this, it has 288 of the 417. Now remember, did you get in to be right, or did you get in to make a certain percentage of the maximum gain? James, I don't like the question. I like to be right. Okay. Now, if we take a look at this, 288, 417, we're at 69% of the maximum gain. Now, you don't typically retire based upon being right solely. You typically retire or you stay in retirement based upon actually moving the portfolio higher and trying to generate potential income from the portfolio, or try to get income that grows the portfolio value that actually tries to get someone to a financial goal. That's what we're talking about. So we're at 69% of the maximum gain. Now on this trade, if someone said the exact same thing, well, I could try to make an additional about $100-ish. They might say, you know what? I'll just take the 287 and say, thank you very much. Have a nice day. So when we did this example, what you're going to notice is the whole trade was done at the same time. Here's what's kind of nice. A collar, defined risk strategy, cap gain. So, I mean, if we would have known the future and we could have said, look, don't do the collar because the stock is going to go up. We didn't know the future. So if we knew the future, hypothetically, we could have made $472. But since we didn't know the future, we did the collar, we made $282 of the potential 470. Now, some investors say, geez, I'd take it. Okay. That's like getting 284 of the 470. And we didn't even know the future. We got 60% of the future that the paper money account did not know. Okay. Now on this last, so I won't take the time, but what we're going to do is we're going to close that position down too. What we talked about today is managing positions, different types of strategies, cash secured puts, cover call, collar. This needs to be something, stock position. This needs to be something that is not once a month, but is really done on a weekly, daily, monthly basis. Okay. Remember I said before, the stronger you are with management, the stronger you're probably going to be with entries. The stronger you are with management and entries, the greater likelihood that you're going to try to capture some of the upward movement in the market. Now, I'm out of my time here today, but that was our focus of the class. I want to give us a practice session on different strategies of managing positions, becoming more confident. Stay tuned for Cameron May coming up next at the top of the hour. Subscribe to the Trader Talks channel on YouTube with Schwab Coaching. And thank you, Connie, for answering those questions in chat. And also remember that all investing involves risk. And this has been the Investing Master Series, talking about management of positions. Have a great day. Take care. Bye-bye.